Good day, this is Mark Giambrone. I am the head of US Equities and Portfolio Manager, and today I wanted to talk about where we are in the market, how we feel about our portfolios going forward, and how the value versus growth cycle is playing out. As we film this, we've had significant volatility in the market recently, and we've had really a pullback of some of the reopening trade that was happening earlier in the year, and a resurgence really of some of the stability and the premium being paid for some of the growth names. This has not dissuaded our belief in any way that we are still in the early innings of a value cycle. And in those early innings, if you look historically, we tend to start to outperform, not just when value outperforms, but value in its own right. And we believe that if you look back to November or so of last year when this value cycle started, we've already started to see some of the benefits of that. And we think we will continue to see that over the next several years. Let me start by saying, why do we believe that? What we have seen is, the reopening trades have really played out very broadly in the market. So yes, we're reopening. Yes, we have a very strong economic backdrop. Yes, we've had very positive both federal, monetary, and government stimulus over this period of time, which has buoyed the market. We think where we are today, since those expectations have already been built into a rising market, is to be much more selective in thinking about which names now can work in any environment really moving forward, not just sort of a reopening, which we believe is largely discounted in the market. So how do we do that? We focus on things that the market has always traditionally focused on: earnings growth rates relative to valuation. And so what we've done is just to give an example, have taken a look at where are the Fang stocks, again, very high quality businesses valued today versus their growth rate over the next couple of years, the S&P overall in our portfolio. And we think this is illustrative as to why we think there's a tremendous opportunity for the names in our portfolio to still significantly outperform as we move forward, really regardless of what type of market environment that we see. So if you look at just the Fang names, what you'll see is we've looked at where we are today, so second quarter of 21 versus second quarter of 23. So we've looked out 2 years. We generally hold things at least that long. And in doing that, what we see is the Fang names have a growth rate of 50 or so percent with a valuation, meaningfully above 30 or so times. And so while 50% is a nice growth rate, and again, these are high quality companies, we think clearly that valuation has already built in a significant growth rate as we move forward. If we look at the market, which we're considering the S&P 500, you see that, again, it's a similar growth rate over that period of time in the 50+% range. And we see a market that's really 23, 24 times earnings based on that. And then if you shift our portfolio, what you see is earnings growth rates that are, a double or triple the rate that we're seeing in those other particular segments, and a valuation that's at least, a 30 or more percent discount to the overall market, and certainly a much bigger discount to those things that are considered really growth. And in doing that, we're very well positioned as the market goes forward and capital flow to where earnings growth are relative to valuation. We think our portfolios and our names can outperform in a rising environment. So if the market continues to rise, we think we can significantly outperform in that environment. But also equally as important, if the market starts to decline, we believe we have a cushion in there, downside protection based on our earnings growth rate that is very strong, a valuation that hasn't discounted those growth rates yet, meaning a significant discount to valuation, buoyed by a meaningful dividend within the portfolio. What we have seen to this point, what I would call we've gotten a lot of the sugar and not yet a lot of the salt. And this is another reason why you have to be very selective, and it's another reason why we think the environment is setting up very well for value versus growth as we go forward. What was the sugar? And sugar, again, is a very accommodative Fed. It's a very accommodative U.S. governmental fiscal policy and a very positive monetary policy. And that's led to a very low level of interest rates relative to what is now a booming backdrop and a very strong economic environment. While that's been very positive to this point, as we look forward again, that's what we focus on in the portfolio. What we see is there's salt coming, meaning inflation rates are very high. Within our portfolio, we want to recognize that. We want to say, okay, well, let's make sure that we have those that have significant brands, that have great products, that have innovation, that can pass through these type of inflation costs to their consumers or because of the strength of their product, versus those that are price takers. Again, that's a significant difference in whether earnings can grow or not in that type of environment. Rates, are probably set to rise meaningfully over the next, foreseeable time period. We'll have a less accommodative Fed. As that happens, that tends to compress multiples over time, especially for those growth names that have a significant portion of their value based on future cash flows as opposed to, real earnings and cash today. And then we're talking about rising tax rates. And so it's hard to know where that will end up at the moment, but we believe that it's highly likely that we'll see higher corporate tax rates and we'll see higher individual tax rates. All of those, again, having a relative impact on the market. And we are finding names within our portfolio that we believe can relatively be in a better position with all of those things happening now from a SALT perspective to be able to outperform, again, in a rising or declining type market, similar to value cycles we've seen in the past, and similar to the way our portfolios have performed over those periods. The last real period that we can see is from 2000 to 2007, and that was a period where not only value outperformed growth, but Barrow Hanley's approach significantly outperformed value, and we think that that's where we are today in the early innings of that. And as we move forward, we think the portfolio is well positioned to benefit from that, again, by being very selective, by focusing on good high earnings growth rate and cash flows, and making sure that we have quality companies but at the right valuation, and populating a portfolio with those type of names. Thank you.